Morning, Mike.
Morning, John.
To start, why don't you introduce yourself and the team that supports the strategy?
Sure. So my name is Mike Poggi. I'm the portfolio manager of our large cap sustainable value strategy. And I joined Brown Advisory in 2003. I was an analyst on the large cap team for a number of years before moving over and helping to launch our small cap fundamental value strategy in 2009. And for the last 10 plus years, I was an associate portfolio manager on that strategy. Then in October of 2022, we launched the large cap sustainable value strategy, which I'm the portfolio manager on today. In terms of the team, I think one of the advantages we have here at Brown Advisory is the size and depth of our team. 20 years ago, we had just a handful of analysts, and now we have a team north of 50. And I think that's a real advantage for us in terms of the eyes and ears we have across the market, up and down market caps, across different geographies and different segments of the market.
Why don't you provide a brief overview of the strategy's investment philosophy?
So the three things that we're looking for any company to make it into the portfolio today are, first and foremost, free cash flow. Secondly, capital discipline, and thirdly, valuation. When we think about free cash flow, we think about it from two standpoints, from a fundamental standpoint and also from a sustainability standpoint. On the fundamental side, we're looking for durable self-funding businesses, businesses that can fund their operations through good times and bad, and so naturally we tend to gravitate to less capital-intensive businesses and industries. From a sustainability perspective, we're really looking for companies today that are playing offense with sustainability to drive better free cash flow outcomes for their business and shareholders over time. Secondly, from a capital discipline standpoint, we're really focused on capital discipline from a CapEx perspective, but also from a capital structure perspective. When we think about capital structure of a company, we're equity holders here, we get paid last. And so, the debt, if a company does have debt on its balance sheet, the terms of that debt mean a lot to us. We're big believers that as much value can be driven through the balance sheet and cash flow for equity holders as it can be through the income statement. And then lastly, from a valuation standpoint, we are a value fund. We're very focused on valuation. The valuation metrics that we really focus on are free cash flow yield on the equity, enterprise value to EBITDA, and net leverage of the company as well.
I guess from there, why don't you share some details on the strategy's investment process?
Sure. So from a process standpoint, we really want to leverage the size of our team and really roll our sleeves up to comb through the entirety of the universe. This is a 1,000 stock universe being whittled down into a 40 stock portfolio. And so, we think we can be very discerning in terms of what makes it. In terms of a name making into the portfolio, we're constantly evaluating potential new ideas with existing names in the portfolio, and we want to set a high bar, obviously. But as opposed to taking a sort of rule-based screening approach on the front end, we really want to sort of go through one by one and look at each company and roll our sleeves up to see what names potentially fit. And through that, we eventually start to narrow the universe down. And within that process, we spend a lot of time talking to management teams. We build out our own financial models. We talk to suppliers and customers, and we do a lot of work, obviously, from a sustainability standpoint in terms of those drivers.
I guess you mentioned some of it, but share a little more detail on the portfolio construction process and what some of the typical portfolio attributes are for the strategy.
So like all strategies at Brown Advisory, we run a concentrated portfolio. So within the large cap value strategy, we run about 35 to 45 names. We want every position size to matter. So we don't have any positions less than 1%, and we think about the high end of the portfolio can be sort of 5 to 6% over time. I think the way we think about it in terms of the key characteristics are kind of two things. One, we want to maintain a high active share. Since inception, we've maintained a very high active share. We look different from the benchmark. We're constantly looking for names that, again, casting that wide net, names that may fall outside of the benchmark. And then secondly, more importantly, where we think, we have the situations where we think the risk reward is really in our favor, those are the names that are going to gravitate towards the top 10, and our top 10 weighting has typically been around 40% of the portfolio.
I guess taking all that, what are some of the portfolio's differentiating characteristics?
I think first and foremost, looking at the value space from that two-lens approach of a fundamental analysis and a sustainable analysis as well, we think is a differentiator for us. We think, the concept of value and sustainability together today is relatively new to the market. And we think there's a lot of names in the value space that are really sort of early on in their journey from a sustainability standpoint. The market's not necessarily recognizing that. Secondly, I think, again, our approach in terms of a non-exclusionary approach, really trying to look at the entirety of the universe, we are going to look different than some other traditional value strategies, and we're going to look different than maybe some other traditional sustainable strategies. Thirdly, I think how we define value in our free cash flow approach and capital structure approach is a little different than other parts of value. There's a lot of definitions of value out there, some deep value, some relative value. But I think the way our value framework is slightly different than the market. I think a lot of times in the market, people hear the term value and they immediately think sort of a big sacrifice in quality. And that's not something we ascribe to. We think we have a portfolio of very high quality companies that have very great competitive positions and can generate consistent levels of free cash flow over the long term. And then lastly, a big part of our philosophy and our process is we really focus on capital allocation. So if our companies are generating a lot of cash in the here and now, the second natural question is, what are you doing with that? And so we're really focused on how that capital is being allocated. In an ideal scenario, we're looking for companies that are really generating so much excess cash that a large part of that is coming back to us as shareholders through either a recurring dividend or a share repurchase program over time.
How do you expect the strategy to perform in different market environments?
Well, every market environment is different, but I think the way I think about the portfolio and how it's positioned, we would expect the strategy to perform well in sort of a normalized, sort of stable and slightly growing market. But more importantly, I think in times of stress and in a severe down market, we would hope the portfolio would really protect capital. Our focus on free cash flow and capital structure we believe gives us that margin of safety on the downside and also that optionality on the upside over time. I think the area, the market environment where this strategy may struggle a bit is in sort of those V-shaped bottoms, a rapidly rising sort of risk-on type scenario. I think a lot of times the highly cash generative businesses tend to underperform during that time period.
So bringing it all together, why invest in large cap sustainable value?
So I think the large cap value space is a very attractive space, and it has been over a long period of time. Value's certainly been a little bit out of favor of late. But as I said before, we think value does not mean a sacrifice in quality. I think with high multiples come high expectations, and what we like about the value space is that that low expectations, low multiple, and that margin of safety. If doing this for over 2 decades now, I'm a big believer that the best way to compound capital over a long period of time is really to avoid large drawdowns. And I think the large cap value space helps give you that opportunity.
So in closing, tell us one thing people might not know about you as an investor.
So one of the things I really enjoy doing outside of my day-to-day work is I really enjoy cooking. And the more I've gotten into it, the more similarities I've seen between cooking and investing. There's a lot of variables that go into cooking in terms of time and temperature. You can attack different recipes in a variety of different ways. But the key thing is you learn through experience over time. And I found the same dynamic with investing. It's really learning through your mistakes over time and building that body of experience that helps hone your process, either through cooking or through investing. And I think I've had the benefit of having a lot of experience here at the firm, making some mistakes over time, but that has helped build me to the investor I am today. And it's that constant drive to get better and improve your process that gets me excited about doing the job every day.
Thanks, Mike.